Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden meanings behind financial filings and make sense of the corporate world. For you today, we're diving into a fresh filing from NextNRG Incorporated, a company that seems to be making some interesting moves behind the scenes. Before we jump in, if you love getting these clear and simple explanations of complex financial document, so make sure you hit that subscribe button and ring the notification bell. Also, we have a fantastic Discord community where we break down these filings together, even further linked in the description below. Alright, so NextNRG Incorporated has just filed a current report with the SEC. This isn't a massive annual filing, but more like a quick update on something significant that has recently happened. Think of it as a company's way of telling the public about an important event that affects their business. The whole filing is about a specific agreement that NextNRG entered into. It is described as a material definitive agreement, which basically means it is a contract that is important enough to potentially influence the company's stock price or how investors see it. So what is this agreement all about? It involves the company and its CEO, executive chairman, and majority stockholder, Michael D. Farkas. Now, this is where it gets interesting. Mr. Farkas is essentially buying himself some company stock, but he is not paying with cash in the usual sense. Instead, he is agreeing to settle some debts the company owes him. This means the company owed Mr. Farkas money, likely from loans he made to the company or its related companies. These loans have been accruing interest over time, so instead of the company paying him cash for that accumulated interest, he is taking that amount in the form of restricted shares of the company's common stock. The deal is for 1 million shares of NextNRG's common stock, valued at $1.04 per share. This totals up to $1,040,000, which is exactly the amount of the interest owed. It's a clever way to address the company's debt to its top executive without immediately draining its cash reserves. However, it's important to note that the principal amount of the original loans remains outstanding. So, the company still owes the base amount of those loans separate from this interest settlement. This transaction means Mr. Farkas is increasing his stake in the company, albeit through a debt settlement rather than a direct cash investment. For investors, this could signal a few things. On one hand, it shows the CEO's continued commitment to the company by converting debt into equity. On the other hand, it highlights that the company might be facing some cash flow challenges if it's resolving interest payments through stock issuance rather than cash. It is also worth noting that NextNRG identifies itself as an emerging growth company. This means it is a relatively new public company and benefits from certain regulatory flexibilities. This often allows them to delay adopting stricter accounting standards for a period, which can be good for managing reported financials in the early stages. Let's look at the bigger picture here from a Warren Buffett perspective. We're not seeing detailed financial tables in this particular filing, which is typical for a current report focused on a specific event. However, the information we do have tells a story. We have a company that owes its top executive a significant amount of money, and instead of paying cash, it is issuing stock. This action can be seen as a double-edged sword. The positive angle is that it demonstrates faith from the CEO in the company's future. He is taking stock, believing it will be worth more than the interest has owed. It also reduces the immediate cash burn for the company, which can be crucial for a business in its growth phase. However, the flip side is that the principal of those loans is still on the books. This represents a liability that will eventually need to be addressed. Furthermore, issuing stock, even in a debt settlement, can dilute the ownership stake of existing shareholders if the company isn't growing its value proportionately. Each existing share becomes a smaller piece of the pie. The key question for investors is whether this move will ultimately benefit the company. Is this a strategic way to manage its finances, or is it a sign of underlying financial strain? Without more detailed financial statements accompanying this filing, it is hard to say definitively. However, future reports will likely shed more light on how the company manages this remaining debt and its overall cash position. So, what does this tell us about NextNRG's direction? It shows a company actively managing its balance sheet, even if it is through creative means. The leadership's confidence, as expressed by Mr. Farkas taking stock, is a positive signal. But the lingering debt and potential dilution are risks that investors will want to keep an eye on. The opportunity here might be for further growth if this debt restructuring allows the company to focus its resources on expansion or innovation. In conclusion, this filing from NextNRG Inc. is a snapshot of a specific financial maneuver, a debt, for equity swap involving its top executive. It is a move that highlights financial management practices and the ongoing commitment of its leadership. While it offers some immediate relief in terms of cash flow, the long-term implications of the outstanding principal debt and stock dilution will be important to watch. Alright, that is our breakdown of NextNRG's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this debt settlement is a smart move or a red flag? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord in the description to join the conversation. Thanks for watching. See you next time.